I'm Matt Bishop with NAREITWeek.com here in New York City at the Waldorf Astoria Hotel for REITWeek 2016, NAREIT's Investor Forum. Joining me today is John Guinee, Managing Director with Stifel Nicolaus. John, thanks so much for joining us.
Glad to be here.
Now, can you start by talking about the valuation of REITs relative to the broader equity and bond market that you're seeing right now?
We feel it's appropriately valued right now. If you look at the overall dividend yield relative to the 10-year Treasury, we're at a historic high, about 210 basis point spread. Multiples are also at highs for REITs, but so is the broader equity markets. Year-to-date, REITs, as you would have expected, have roughly outperformed the overall equity market by about 300 to 500 basis points in a declining interest rate environment. We should point out, though, that we think further declines in interest rates, further flattening of the yield curve, will most likely not have a positive effect on REITs. However, we think that if the market is surprised and interest rates go up, REITs will be significantly affected in a very negative manner.
And what are the factors that are driving individual stock performance versus, say, the broad REIT market?
Well, we think, which is I think also consensus, is that we're at the end of the cycle. And what's happened over the last 6 to 9 months are two things. First, we're clearly in a risk-off versus a risk-on environment. And second, the incremental investor appears to be a generalist versus a REIT dedicated. And if you look at the last, until about a year ago, for 4 or 5 years, you saw the REIT dedicated investors getting increasingly good funds flows, increased AUM, were the incremental investor. Over the last year, that shifted, so now you have the generalist being the incremental investor. The generalist is much more focused on earnings growth, dividend plus dividend growth, than they are net asset value premiums and discounts, which has, and also they're much more big picture oriented, and so that combined with an overall risk off environment has shifted the focus much more to those REITs that have consistent earnings growth and consistent dividend growth, rather than just net asset value discounts.
And lastly, turning to particular segments of the REIT market, how would you describe office and industrial fundamentals?
Industrial fundamentals first, because that's easy. On a national basis, they've been surprisingly good. Supply has remained in check. A combination of yields, development yields not quite making sense in many markets, hard costs going up, and also banks being very disciplined in their lending practices. And the net is you can look at almost all markets and feel very good about industrial fundamentals, particularly Southern California, where you actually have a declining inventory base while combined with a healthy economy. They're simply not making any more land in Southern California. Office is very, very different because it's very market and sub-market specific. And what's interesting about the office markets these days is that 3, 4, 5 years ago, you had a consensus opinion on the strength of New York City, San Francisco, Boston, Washington, West LA, the suburban markets. Now there seems to be a lack of consensus and very, very different opinions. Where we are right now on our stock picks and our stock selections is we put our stocks into 3 basic buckets. We have a bucket of what we call well-run companies, good fundamentals, good balance sheets. We expect them to modestly outperform the overall index. And in that bucket, we put almost all the industrial REITs, if not all the industrial REITs, Empire State Realty Trust, Highwoods Parkway, Cousins with a southeast focus, Armada Hoffler, WashREIT. Then we have a bucket of select names which we think maybe are oversold, very, very inexpensive by historic metrics, which we think have a very good chance of significantly outperforming the market. In that bucket, we have SL Green, Vornado, Kilroy, McCallie. And then we have the remaining coverage list are names that we expect to most likely modestly underperform the index, nothing significant, but companies which have okay fundamentals, okay balance sheets, but nothing great.
John, thank you so much for joining us.
Thanks for having me.
For more from REIT Week 2016, be sure to visit REIT.com.